we could be holding in the balanced market throughout the summer as people are on vacations and people are off doing other things that they'd like to do besides looking at real estate. But entering the fall market with the potential of a third rate cut, that could signal a change in the real estate dynamic as... Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadyen, and I'm your host. I can't wait to get you into the flow. Well, welcome back, guys. If you aren't already over the Bank of Canada hangover yet, we've got more news for you. Data and analytics and information, all that kind of fun stuff. But as I always like to do, I'm going to freestyle a few comments as I break into what is expected to happen to the real estate market now that the Bank of Canada has decided to reduce interest rates 0.25% for the second time in 2 months. That's right, twice in 2 months the BOC has reduced interest rates. And unless you've been hiding under a rock, you know that the overnight rate right now is 4.5%, which is a reduction of 0.5% from the high. The high itself was 5%, and it had held for about 12 months. It had held on for, and that was really an eye-opening timeline, because if you look back historically to the timeline that it takes from the Bank of Canada's basically height of their market, so when they raise rates, to the point at which it makes an impact on the actual economy, it's 12 to 18 months. Now, they started raising rates over 18 months ago, so over a year and a half ago in 2022, and rates now at 2024, 2 years later, we're starting to see the impacts in a big way and have been for the past few months. But realistically, it's been 12 months since that last rate hike, and now we're really starting to see the impact. In fact, in such a substantial way, well, that they've reduced rates twice in a row when we thought it wasn't going to happen for quite some time after a really interesting Q2. Welcome back to the podcast, guys. I really enjoyed having a lot of different conversations lately, and I don't want to just make it all about news. To be honest with you, I enjoy talking money and the psychology of money, which kind of leads to this next conversation about the psychology of where real estate could go after the second rate cut. You know, an interesting thing, I read not a publication per se, but a survey that was done on, I believe it was 1,000 Canadians. It was a BMO survey, and it talked about specifically when are you most likely to buy real estate? And it referenced the rate cuts and said 0 rate cuts, 1 rate cut, 2 rate cuts. I'm going to wait until after rates have come down over 1%, and I'm just going to wait and see. And interestingly enough, obviously the vast majority of people said after 1 rate cut. So as a totality, very few people said after 0 rate cuts. The number jumped up quite a bit after 2 rate cuts. And then after this, so it basically said, I'm going to wait and see, was over 50% of Canadians waiting. And in most circumstances, suggesting that they're going to wait until 2025 to buy real estate. So after the 2024, so June rate cut, which was a 0.25 point, although there were a lot of people out there suggesting beforehand that would really, really, really heighten up the market and the market would start moving, it didn't really happen. But something did happen. And that something that happened was that in many parts of the market across the country, it's not that the real estate market really, really picked up. It's that it stopped declining at the levels that it was before. And now, don't get me wrong, you have some markets like the Greater Toronto area and the well-publicized condo issue that's going on there, and a few other submarkets that are, impacted based on higher rates. But the vast majority of the market stopped seeing the I don't know if you want to call it a free fall, but declining house prices that many were talking about for the time beforehand. So I think that leads us to the point as to that lead us to understanding what the outcome will be looking into the second half here of 2024. So, summarizing a couple of the points, I think it would be important to talk a little bit about where rates could go based on the implied markets, and more importantly, again, as we walk through it, what could happen. Now, let's talk some numbers and rates. If you didn't catch some of my previous conversations, the move itself impacted rates to bring them down a quarter point. That would be variable rates, not fixed rates. Now, the fixed rate market might start reacting, but we haven't really seen it happen yet. And a lot of the reason for that is that the funding costs of fixed rates have already been compressed so much, meaning a lot of the banks have already pushed their rates down lower than they typically would anyways. So if we do see fixed rates decline, it'll probably be a little bit slower and it won't be by the exact same amount, kind of like we saw in June. Now, for those who had a variable rate mortgage, if they had a 25-year amortization, they'd see about a $15 per $100,000 reduction in their overall borrowing power or payments at this time right now. No real impact to buying power yet, but if we do see fixed rates start to follow at least even 0.05, 0.1% on the rate market, which we probably will see in the next couple of weeks here, there will be a slight impact to borrowing power. Now, that obviously can have an impact to people looking to borrow to their maximum, which a lot of Canadians are. So there's definitely an opportunity there for us to see that have an impact on the overall real estate market. Additionally speaking, the other thing is, and then back to the psychology, it just kind of brings back what we talked about before, confidence in the marketplace more than anything else. Those people that were suffering at those high variable interest rates, well, I mean, it's not really going to provide a lot of solace for them. But for those people on the sidelines wondering, well, is it a good time to get back in? They might be thinking, okay, well, we've seen rates come down once, twice, they might come back down in again. Okay, well, we all know that as rates continue to come back down, more people are going to jump back in the marketplace. So do we start to see the pause of rates or house prices from going down and start to head back up? And are people going to wait until after that happens before they actually jump in? It'll be curious to see. Back to the BOC meeting. Here's a couple of highlights that we need to talk about here from the press conference specifically. So Macklem said the expected direction of our policy rate is lower. So he specifically stated that he anticipates the rate market to go back down. I mean, it's the first time in a long time that he's been that open about it. Usually they've been a lot more defensive about the direction of where they're going. So he's been much more open. They also indicated that the CPI inflation will set around 2% target for the year. Again, another reason to suggest that rates will continue declining over the course of the year. The path to 2% may be bumpy. This is another reminder that even though rates have gone down twice in a row, it is very possible that we see things pause for some time and it doesn't follow this perfect trajectory like most of the economists are projecting. It's an imperfect marketplace. And there's a lot of reasons to suggest that we could see things kind of be bumpy for the up or for the down here going forward. They also mentioned that shelter and service inflation are the two concerns the bank flagged today, but both are expected to ease somewhat kind of looking forward into the near future. Overall, the bank sees CPI inflation at 2.4% for the end of the year, which is up 20 bips from their last guess. Interesting to note. We also note that from this press conference that more households due to immigration is boosting GDP. So they're suggesting that immigration itself is what's boosting GDP. On and on and on. A couple of other key points. They suggest that the monetary policy is going to be somewhat restrictive, but not as restrictive as it has been in the past. And the bank also expects an economic rebound late this year and next year. Very interesting information. Nothing crazy to pull from it, but some interesting feedback, which leads us to our next point. What do the markets actually see and what are the markets projecting now? It's slightly adjusted from the date, July 24th, on where the markets are projecting. But the odds right now of another cut on September 4th are well, they were about 50-50, and they've slightly increased across the course of the week, with many of the economists going out with their predictions from all the major banks by the end of the week, suggesting that 4 out of 6 of them are actually projecting that they see a September rate cut. Wow, I'm stuttering here today. I've got to get back on track. So with that being said, the 2 rate cuts and then a potential third one is a major pivot in the mindset of Canadians, I believe, as it pertains to real estate investments. And one of the biggest reasons that we saw real estate values continue to hold steady, aside from the fact that a lot of people have been waiting for rates to come down, is the fact that there have been so much inventory that we stepped into what was, moreover, a balanced market, something that a lot of consumers have been calling out for the better part of the last 5 years, realistically, since 2019. So we're in this balanced market right now. And for a variety of reasons, we could be holding in a balanced market throughout the summer as people are on vacations and people are off doing, other things that they'd like to do besides looking at real estate. But entering the fall market with the potential of a third rate cut, that could signal a change in the real estate dynamic as we start to see the typical listings come up. But unless there's a flood to overall markets, that with the potential of more buyers re-entering the market with rates being lower and affordability higher and qualification going back up, not to obviously a high level of affordability, but much better than it was. Picture back in 2023 when fixed rates were over 6%, variable rates were nearly 7%. This represents a lot better situation for a lot of buyers. And for those who've been watching for a year, it sure looks tasty to see that happen. And like I said before, as we all know, with rates coming down, property values will continue to go up. So some other key takeaways from this announcement, some just general feedback that maybe not necessarily from this announcement, but the Bank of Canada is weighing in on and looking at is population growth. It looks like, and I mean, take it for what it is, but it looks like we are seeing a reduction in the amount of immigrants coming into the country, or at least we're supposed to be seeing a reduction in the amount of immigrants going to the country, which essentially puts us in a position where they anticipate that housing requirements will decline over the next couple of years. But of course, as we all know, most people that are immigrants to our country don't necessarily buy real estate in the first 1 or 2 years. In fact, in my experience, I find that for most immigrants to our country, they end up moving to the country, finding a place to live. They rent for a couple of years, build up their savings, stockpile, depending on who they are, and don't end up buying for somewhere between 3 to 5 years. Although the chart that I found here shows that the average immigrant who's actually buying doesn't actually buy until years 8 to 10. So for the reality of our markets and many others, it looks like there is no real impact for immigrants in the marketplace, other than the fact that there's the rental market, which they need to consider. So again, looking at the markets going forward here and just kind of trying to understand where does the rate market go and how does that impact what people are going to do, there is, according to, again, all the banks, the 4 to 6 major banks, specifically TD and CIBC, notably suggesting that we still have about 1.75% of easing to go in the marketplace, which would bring us from an overnight rate of 4.5% down to an overnight rate of 2.75%. That represents a significant decline, basically almost cutting us in half from the height of the market in the first half or first quarter of 2022 as the rate market started to increase. What that means overall, and I should reference by saying that's over the course of the next 24 to 36 months, but what that means overall is that, again, it will bring a lot of people back to the marketplace, but it also could reference the fact that the Canadian economy is doing really, really poorly if that starts to happen, trying to bring us back to that normalized level or market. Now, we referenced this before, but fixed rates, the projection at least as of right now, are projected to decline over the course of the next 12 to 24 months. But I think a lot of people are forgetting when it comes to fixed rates that A, those two don't necessarily work perfectly together. But the second part, B, is that fixed rates themselves have been coming down significantly. I mentioned this earlier in the podcast. They've come down over 1% in the last 12 months. So we've already seen the fixed rate market come down. And for many, they're suggesting that the fixed rate market doesn't come down as significantly as the variable rate market. And we start to settle in that somewhere between that 4 to 4.5% range. So the question, for many people looking going forward is not only what do I choose from a mortgage perspective, and I'm seeing a lot more people ask about the variable rates and should they do so, but the other question is, again, how does this impact the housing market? So I went and did a little bit of research and I looked up what the overall consensus of the marketplace is and how it will impact the marketplace as a whole. What I noticed that was really notable, I'll pull out a couple key points. CIBC itself, Avery Shenfield, the chief economist at CIBC, saying that with the two increases that have already come and the two coming from here until the end of the year, at least that they're anticipating, they noted that we will start to see a reinvigoration in the real estate housing market. We also saw some notes from Royal LePage. Royal LePage's chief operating officer suggested that we've already seen some signals that the economy is moving in the right direction, which has started to bring back interested buyers into the fold. With mortgage qualification thresholds continuing down, they're suggesting that sideline buyers have the confidence now to make the return to housing markets as demand starts to come back in the fall. Also, she noted that the much-needed inventory has been building in major markets for the last few months, which is giving buyers more options, which could tempt them to move into the marketplace in the fall. A variety of other news sources here, including CPA Canada, have suggested that Canadians with variable rate mortgages are breathing a sigh of relief. No shit. And also seeing lower payments. And those in fixed rates are also going to see the benefit when it comes to renewal times. it looks like in their suggestion is that for Canadians, top priority is to buy a home. They're going to see a significant reduction in the cost of borrowing, which is going to drive some back to the marketplace. Anyways, no big statements from those, but looking into a couple of other markets, I think it's more interesting to examine specific markets. Obviously, with the housing market is experiencing the downturn, specifically in the Toronto market, the condo market being much slower, there is a suggestion that there is a massive opportunity for people who want to get into that marketplace to benefit from the potential rate drops. What's been most interesting to pay attention to is the fact that a lot of these condo markets, although the house prices or these properties are listed and have been listing for a long time, they've kind of hit this artificial bottom. They're not going down to the same rate they were before. And it seems that most of the homeowners of these condos, instead of taking a massive loss, are going to be willing to just wait and wait and wait until the housing market recovers. Now, with a variety of pre-sales coming up in the early part of 2024 and 2025, the question mark is, does that continue, or does that create more opportunities for potential future investors or people buying these homes to get into these properties at a much greater value? Many will wait and see what happens there, and I'm kind of just genuinely curious of what is going to happen. But for the sake of conversation, definitely curious to see where the market goes. So this really begs the question as to not only when do people get back into the marketplace, but when they do, what should they choose from a rate perspective, from a timing perspective? Now, I broke this down in one of my YouTube videos, or if you haven't seen it yet, it will be coming up very soon. But I guess the overall consensus right now, it really comes down to a variety of things. First and foremost, what is your comfort with risk? Risk being that you don't know exactly what the interest rates are, or a risk that you are locked into a rate that may not be as low as it could go. So objectively speaking, if you're someone who's getting into the market right now, and if you are very conscious of your finances and very concerned about where they are, and you don't like to necessarily take a bet on the future, then I think it makes more sense for you to consider the possibility of hopping into a fixed rate. Right now, the rates are around 5% range, just above or just below, depending on whether you're putting less or more than 20% down. And so it would suggest that right now the fixed rate is probably a safer play, but you do have to be hyper conscious right now of the term length and the penalties associated with those terms. So for example, if you're taking a 3-year fix with a chartered bank, you got to watch out for some of those nasty prepayment penalties that no one ever thinks that they're going to pay until they do, whether it be because you want to refinance when rates go down, or because you have to move, or because you have a death or a divorce or something like that happens. The same thing happened in 2019 to 2020 when the rate market went down and everybody wanted to capture those lower rates. Now, we may not see rates go down as much, but you best believe when people see rates 1% lower than where they're at today, they want to actually take advantage of that, which leads us to the next point. If that's who you are, and if you can qualify for it, it's time to consider the possibility of the variable rate mortgage, with the rate projections coming out as an advantage right now on the variable rate market, depending on the discounts that you can get. Notwithstanding the fact that we might see discounts go lower, it could be the time to start considering the possibility of a variable rate. The key, though, there is to consider the type of variable. Now, there's nothing wrong with either option. If you take a fixed payment variable, it's just the payments remain the same and more goes to principal if rates go down. But if you are looking to see that relief from a payment perspective, then you really want to be conscious of choosing a floating variable rate, which very few lenders actually have. You need to know which ones do, and it's typically speaking not the big banks. As a general consensus of all this information, all this data, I think at the end of the day, what this leads to me is it starts to reduce the amount of confusion from many potential home buyers, which will lead them to starting to get off the fence as there becomes more positive momentum and positive interest in the marketplace. Assuming people can qualify for what they want to do, you'll start to see more people jump back in. And no doubt more people will wait and wait and wait, because that's always the way it is. But if I were to look back in 2 years from now in a crystal ball, I truly believe that this area of 2024 and just 2024 in general will be one of those times that people look back at and said, I wish I did. I wish I did. Not because I know anything particular, not only because I bet on this particular market right now and just bought into it myself, but because I've seen this cycle happen a few times. It just feels like now is the time where momentum will just get started, and that firecracker and that match is lit, and things will slowly start to simmer before things really start to take off in the end of 2025 and of course into 2026. So again, as always, if you have some feedback on this, please leave it in the comments below if you're watching on YouTube. And if you're listening to the podcast, the thing that would help me the most is if you were to share and tag me. You can tag me at Flow Mortgage Co. or at the Mortgage Pug on Instagram. Give me a follow if you'd like a little bit more of this information. I'd love your feedback on the podcast, the episodes, and what you'd like to see more of. Thanks so much, and we'll see you on the next one. That was an unreal episode of The Flow. I hope you enjoyed it as much as I did on my side right here. If you haven't already done so, make sure to check out all of the incredible resources that we have available. You can find us on Instagram at Flow Mortgage Co. You can find us on our website, getflowmortgage.ca. And of course, don't forget our free first-time homebuyer masterclass that's currently available on our website for anyone who listens to the episodes. And if you loved what you listened here today, the only thing that we ask for is to share this with someone else that you think this could help. And hey, maybe leave us a great review online.